Hello, this is Ike Hoffman with Tactica Real Estate Solutions, and today I'm going to walk you through how to use my free multifamily valuation model. If you're seeing this video on YouTube, you can download the tool from tacticares.com. The link is below. Two things with this model. The page you're looking at, this author tab, I would really appreciate if you left that intact. See, this links back to my site and it helps me stay in touch with users. So if you're sharing it with coworkers, friends, other people in the industry, it will allow them to know where it's coming from. They can check out my site, see the content that's being published, and more importantly, know if there's bug fixes or improvements to this model. The other thing I ask is please don't sell the model. I think it's pretty self-explanatory why I wouldn't want that to happen. But with that, that's really it, and it's free to use, and I like to think that it's simple, sophisticated, and hopefully helps you streamline your multifamily analysis. You know, this is for more experienced investors. I'm not going to spend a lot of time diving into the lingo and the terminology. You know, I expect that you know what cap rates are, what return like a cash on cash or an IRR is, and in financing terms, things along those lines. There's other great resources out there if you're just getting started, but I'm really trying to create a tool for people that have some experience owning real estate and just want to streamline and analyze deals, vet deals more efficiently. And that's where I see my financial models filling a niche. So with that being said, let's get started. I'm going to look at a scenario today where we're looking at the financial feasibility of a 24-unit apartment building. So the first thing we need to do is check out our summary tab. Before we get started inputting the model, I really expect this to be an exercise that's going to take you 20 to 25 minutes once you have some financials and a rent roll from a broker or from an apartment owner. The video might take a little longer than that because I need to explain some things, but 20 minutes plus or minus is really the target time frame this should take once you get used to the model and are firing at all cylinders. So the first thing we need to fill out is just some general property information. I'm not going to do that right now. It has no effect on the actual numbers that we're going to be in the returns that we're going to be looking at here in the short term, but just the general property information is something that you can fill out on your own when you're doing this, but to save time, I'm not going to. A lot of stuff on this tab will populate once assumptions are filled out throughout the model. So there's going to be a lot of errors at this point, and that's okay. As you're seeing here, there are black cells and brown cells. Brown cells are the ones that you need to fill out. Black cells are either formulas or just hard-coded items that you don't need to worry about. So the first thing we need to do is just fill out some closing/residual assumptions. So when you're buying this property, we need to put in what those closing costs, escrow costs, things like inspections, some legal fees, and appraisals would be. So I'm just going to put in $45,000 for no particular reason. This would be something I would adjust as I'm getting more serious about a deal and fine-tuning my underwriting. So then the next two assumptions have to do with the residual, and specifically the residual proceeds you'll get once you go sell this apartment one day. So the stabilized cap rate today, I'm going to put in 5.5%. Be reasonable. Think about it in terms of, okay, if this property hit the market and, you know, it was in decently good shape, not a lot of deferred maintenance, what would the true cap rate be? And then the increment per year is going to determine how much that cap rate will increase by each year that you hold the asset. So I'm going to put in 10 basis points, which is 0.1%. So in this example, if you own this property for 1 year, the residual cap rate that is used to determine the sale proceeds would be 5.5 plus 10 basis points, or 5.6%. You know, if you held it for 5 years, the residual cap rate would be 6%. So the higher the increment is per year, the more conservative your underwriter is being. You really don't want to just depend on that residual value to make the deal work. So be cognizant of that. You're going to enter in a brokerage commission when you go sell it. You know, typically on a smaller deal, a broker might want, you know, between 75 grand and 125 grand. So I'm just going to put in 3.5% here. And then other closing costs, there's typically like deed tax and other miscellaneous items, legal fees, stuff like that. I'm just going to put in 0.5%. So the total sale cost will be 4% of that residual value. We can put in some financing terms too. So I'm just going to call the loan bank loan. We'll target an LTV of 70%. the loan amount doesn't populate right now because we don't have a price for that we're willing to pay for the apartment building. Interest rate, I'll use 4.25, a 10-year term, 30-year amortization, and a loan cost of 1% of the outstanding loan balance. And then interest only, I'll do 12 months. If you were assuming a loan, you could click yes here. You type in all the pertinent loan information just like you would with a new loan. You just have to specify which month you're assuming that financing, and then the model would figure out what your monthly cash outflows would be for interest, principal, and the outstanding loan balance as well. The model supports 2 financing pieces. So if you did have a second loan, like maybe you were assuming a loan and you wanted to put that into the first loan slot, and then you wanted to enter in a supplemental in the second, you're more than welcome to do that. Another common scenario might be is if you have a contract for deed, you're getting seller financing, and then you want to tack on an additional supplemental. So I'm only going to be using one piece of financing. We're going to assume it's a free and clear loan, so I'm going to elect no here. Right above, there's some pricing stuff. This really doesn't do much for us right now, so I'll come back and revisit this once we have our model populated. But you essentially can adjust your hold period, and it'll tell you how the levered IRR and equity multiple will change, based on the other assumptions we're going to be inputting here shortly. So the next thing we need to do is fill out our unit mix. I just have some generic floor plans in there right now. We're going to pretend that we received a rent roll from a broker, in a PDF. I inputted it into Excel in this blue box here. I did some calculations at the bottom just to figure out, obviously I counted all the units. There's 24 units, calculated the average square foot and average rents. So that's what we need to input into this unit mix. So I'm going to go ahead and delete these rows that I don't need. It's just going to be a 1-bedroom and a 2-bedroom. With larger deals that are more institutional in nature, there might be a lot of floor plans that have different codes. This deal, obviously, it's not that sophisticated. I'm just going to delete that. It's not necessary. There are 12 1-bedroom units in this particular deal and 12 2-bedrooms. You can see the pie charts below starting to populate. Square footage, if we go back and check, the square footage for the ones is 675, and for the twos, it's 825. I'm going to enter that in. And then we just need the average rents, which are $840 and $942. So $840 and $942. So our unit mix is complete. We can see 24 total units, average square footage 750, 18,000 total square feet. The average blended rent is $891, rent per square foot, total monthly rent. And then the last thing we need to do, it looked like there were 2 vacant units. See these 2 blanks here? So I'm going to go ahead and say that out of the 24 units, there's 22 occupied units. So the property is currently 8% vacant. So with that inputted, now we can move along to the financials. In this particular example, if I scroll over a little to the right, in this gray box, we received a T12, and then we received 3 months of monthly financials that constitute the T3 amount. But we don't have, as you can see in my model, we can go back 2 years, so 2017 and 2018 information. Typically on smaller properties, the financials will be less sophisticated, and you're kind of lucky to even get a T12 at all. So we'll just consider ourselves fortunate in this situation. And I'm just going to go ahead and hide these 2 columns as they're not necessary and we don't have data for them anyways. And then we can start, I'm going to make this smaller here, and we can start inputting our financials. So we have T12 information. You can see there's a lot of brown line items here that we're going to be adjusting. I like to include more than what will be necessary, because you can always just delete rows for stuff you don't need. I'm going to show you how to do that. But I'm just going to get entering in all this information. So 244,000. The financials just show gross collections, so there's no vacancy loss or loss to lease. Looks like there's some specials, which would be concessions. The negative numbers that you need to input, there'll be like a orangish tint. So that's just to know that those are things that you can adjust. Vacancy loss, like I said, there's no vacancy loss. And then bad debt, minus 2,400. And then there was some laundry income, 65, and then just other miscellaneous income of 2344. And then if we go down to the expense part of it, we can enter those things in as well. So 1580 for admin, 234 for marketing. There's no management fee. That's something that we're going to have to add in our pro forma. No asset management. There's no payroll either. So water and sewer, $96.50. Trash contract is $8,700. Gas for heat is $11,040. And then electricity for common areas is $1,789. R&M is just a combination of, typical repairs, contracted services, turnover, supplies, things of that nature. I just grouped it all together. $34,671. Because turnover and contract services are all in R&M, I'm just going to delete those for now. On a more sophisticated deal that had more detailed financials, I would break those out so I have a good idea of how the R&M is truly allocated, but this is just meant to be a quick exercise. Insurance, $12,499, and then apartment real estate taxes, $32,418. All right, so I'm going to go ahead and start deleting rows that I don't need. Delete all this other stuff. I'm going to leave payroll and management fee because I will have an assumption for those in the pro forma. Then up on the revenue side, I'm going to leave water, sewer, and trash. Current ownership is not billing back for that, but that's an upside opportunity. In this particular case, comps in the area are billing back for water, sewer, and trash. So that's something I'm going to try to phase in here in my pro forma and see how the numbers would look if I'm able to do that. And then I'm also going to leave garage parking. There's 20 garage spaces for these 24 apartment units, and the residents that are utilizing garages currently get them for free. Then I'm going to delete employee discounts and model units. So there's some upside in this deal, which is exciting. Now this model is shrunk a little bit and is a little easier to digest and manage. So now I'm going to enter in the T3 revenue items. So I'm going to go back, reference the financials here off to the right. Revenue, $61,763. Concessions, -$200. Bad debt, -$363. Laundry income, $1,455, and other. Oh, looks like I deleted my other. I'm gonna go back. Sorry. Accidentally deleted my other income item there, so I'm gonna bear with me for 1 second here as I get everything updated and correct. All right, sorry about that. 61,763 minus 200 minus 363 for bad debt. Laundry is going to be 1455, and other income will be 525 for a total of 63,180. I'm just going to highlight over this and confirm 63,180. Okay, so we entered everything in correctly. Now I'm going to hide this column so I only see the annualized T3 amounts. It's highlighted pink just so you know that it might look a little more intuitive. And I'm going to go ahead and make this T12 text white so I know that it's inputted correctly and I don't need to worry about it anymore. So it breaks down the T3, T12 metrics. The model will break it down by per unit, percentage of GPR for revenue items, or percentage of EGI for expense items, and then on a per square foot basis. I'm not a big per square foot guy, so I'm actually going to hide that column. I'm going to make the model take up the whole screen here. In the green columns, this is showing your trends, year-over-year trends. Because we didn't have 2017 or 2018 data, the trends from 17 to 18 or 18 to T12 are blank, so we can go ahead and hide those. They don't really tell us anything at all. And then we transition into our forecasted year one assumptions, but we haven't made any assumptions yet. So to do that, we just need to slide over to the right a little bit, and this is where we're going to start making our assumptions for the pro forma. So one thing I learned over my many years analyzing real estate is that many investors during the initial years of a pro forma, they like to be pinpoint accurate. They don't want to just do 3% rent growth on revenue, 3% expense growth and call it a day. They really like to plan ahead and look at the upside of the deal and figure out how much cash flow will be coming in those initial years, and when they can, and how fast they can phase in something like parking revenue or a RUB system or renovations, whatever the case might be. So I give you 3 options for years 1 and 2 underwriting. You can either underwrite based off of a growth percentage over historicals. So for example, in this first column, if you wanted to grow laundry income by 3% over the T3 amounts, you just type in a 3% in this column right here. If you wanted to do your laundry, if you wanted to underwrite your laundry as a percentage of total GPR, you would enter in your assumption here. Or if you wanted to do it on a per unit basis, which I do a lot of underwriting based off of per unit because that's what I'm comfortable with, that would be reserved for the 3rd column. So just to give you an example how this might look, let's just walk through all these assumptions. So the gross potential rent is a little different than all of the other assumptions. I'm going to put in 5%. I think there's significant rent growth upside at this property. But this first assumption is going to take the current rent roll annualized and increase it at 5%. So you can see here, the FY1 rent assumption, we plug in 5%, is $269,438. So what this assumption is doing is it's just going to the unit mix. It's grabbing the total monthly potential rent, it's annualizing it, multiplying it by 12 essentially, and then growing it at 5%. And then you can see it's $269,438. So that matches out. So now, in most of these smaller properties, there's never going to be gain or loss to lease. You're going to see that on bigger deals that are more institutional in nature. I'm just going to delete that row for now. It's not necessary. Concessions. So there were a small amount of concessions in the trailing numbers. You can see as on an annualized basis, it was negative $800. So I'm just going to type in minus 100% and cut those out. Should be fairly easy to do. For vacancy, I'm going to do an assumption that's 5% of GPR. Sorry, you need to actually type in negative for your negative assumptions. So negative 5% of GPR. Again, that's this middle column if you want to underwrite your assumptions like that. And then for bad debt, I always like to keep some bad debt buffer, people not paying rent. I'm going to do 25 basis points as a percentage of GPR. So that's $674 a year. And then we get to garage parking. There's currently not any parking income, and the comps in the area for detached garages, they're charging $40 per month. So there's 24 units, and I'm going to try to phase that in over 2 years. So hopefully when it's all said and done after 1 year, I'll have at least 12 units, which is 50% of my unit mix, paying that $40. So I'm going to say 12 units times $40 per month times 12, because we want the annual per unit, and then divided by the unit, the total number of units, which is $240 a month, or would translate to $5,760 a year. For laundry, I'm just going to do a 3% increase over T3 amounts, keep that simple. And then water, sewer, and trash, I'm going to follow a similar logic to parking. I think I can charge $5 a month for trash and $30 a month for water, sewer, but I'm going to phase that again in over 2 years. So I'm just going to take, for trash, it's 12 units, which is 50% of the unit mix, times $5 times 12 months divided by 24 units. And then for water, sewer, it's going to be 12 units times $30 times 12 months divided by the unit mix. And that's $180 per unit. And then the other income, miscellaneous fees and other income, I'm just going to grow 3% over T3 amounts. Most of my expenses, I'm just going to do 3% over trailing 12 amounts. In my opinion, the expenses were reasonable. Repairs and maintenance were a little high, but I think it's better to run a conservative model at this point. Management fee, I'm going to run as a percentage of EGI. So I'm going to type in 5% in this middle column. And then payroll, there was no payroll, right? And I might not need to allocate an entire employee to this property, but I'm going to assume that, if I bought this place, I'd have a caretaker that could handle some turns, handle some shoveling, snow removal stuff, vacuuming common areas, things of those nature. And I'm going to underwrite a $500 rent premium. So they're going to get $500 a month. So I'm going to annualize that. And then I'm going to divide it by the total number of units. So that's 250 a unit in payroll. And then we get to these gray cells, and I haven't explained them yet. These gray cells are being calculated elsewhere. So in utilities case and utility reimbursements, you're going to underwrite each utility separately. And then what's showing up in the gray is just the aggregate total of all of those. So for example, I'm going to grow all my utilities expenses at 3%. And you can see then utilities as a whole then increase at 3%. It's 11.71% of EGI, or $1,338 per unit. So R&M, insurance, I'm going to grow at 3% as well. Apartment taxes is shown in air right now. We have a separate tab dedicated to that we'll get to shortly. And then reserves, I'm just going to set at $300 per unit. Reserves will stay at $300 per unit for the rest of the hold investment period from years 1 all the way through 10. So you don't need to enter that in anywhere else. And just there is a key below. So anything that's kind of this beige color, those are assumptions that you need to make. But anything that's gray, the assumption is made elsewhere and is just being summarized in the cells. So once we have year 1 complete, we can take a look and really compare how forecasted year 1 looks through the historical financials. Just to make this easier, I'm going to go hide some of these other metrics and just show, so we can see T3, T12 right next to FY1. We can see the EGI increases by 8.52%. We can see expenses are still showing an error because we haven't inputted real estate taxes yet, but we'll come back and analyze that once we've completed our real estate tax assumptions. But really, there's a lot of columns here and there's a lot of good data, but I know a lot of people, it might be a little overkill. Like I said, I don't really like the per square foot stuff. It doesn't do a lot for me, but other people live and breathe it, especially people that are used to developing properties. So it's totally up to you and how you want to look at this. Just to make it simple for now, let's hide everything except just our gross annualized numbers. So we have T12, then T3, T12 for historical, and then once we get into the Proforma, it's just FY1, and you can just look at stuff side by side, and there's a lot less fluff. So now we need to make our year 2 assumptions. I'm going to do another year of 5% rent growth. Concessions, since we already decreased them to 0, we can just leave it blank. It'll be 0 in the model. I'm going to continue to run vacancy at 5% of GPR, and I'm going to keep bad debt as 25 basis points of GPR. So garage parking, remember we're phasing this in over 2 years. I can literally just take this assumption and multiply it by 2. Now it'll be fully phased in and I'll be getting $480 per unit per year. Laundry, I'm going to continue to increase at 3% annually. And then I'm going to multiply the water, sewer, trash by 2 because it's going to be 100% phased in. There's only 50% phased in after year 1. So you can see total I'm getting $422 per unit in utility reimbursement. And then pretty much across the board here, I'm going to just grow all my expenses at 3%. I'll continue to run management at 5% of EGI. Drag this down to expedite a little bit. And then finally, once we get to year 3, you lose a lot of the flexibility. You can only make an escalator assumption. So for example, I'm going to type in rent growth of 3% forecasted year 3. All these other cells from years 4 through 11 are linked to that, but you can overwrite it. So if you thought for some reason you're going to have 5% rent growth in year 10 or 6% in year 9, you're more welcome to overwrite. I just link it to FY3 because most people, they hone in on the assumptions early on in years 1 and 2, and then they'll just use more of a generic escalator in future years. So vacancy, I'm going to continue to run at 5% of GPR. I'm going to hold bad debt steady at 0.25%. And that will go all the way through. Just going to grow all my revenue items at 3%. If you leave these cells blank, it will show up as 0 in the Proforma. So just make sure that you're cognizant of that. All expenses 3% as well. Drag that down. And then we're good. So then if you scroll over to the right, you have all of your cash flows to NOI. And see, it looks like other income is blank, so I must have missed. Yep, see, I forgot to grow at year 2. So then year 3, where it's growing 0 at 3%, which is 0. So always make sure you scroll over, make sure everything looks good. Taxes are still firing in air, so that's our next step. And so for real estate taxes, the biggest thing that we're trying to capture here is if there's reassessment risk. I've analyzed deals in 8 different states, and the tax calendar works differently in every single one of them. So it's really hard to come with a custom real estate tax page for your state. This is some of the further customization I offer on a consulting basis. So if you lived in Minnesota or Florida or Washington or whatever the case might be, I can create a tax tool that is tailored to your state and your tax calendar. But in this model, I really wanted to create something that worked for everybody. And the biggest things that we're trying to capture is when taxes will reassess, how much reassessment liability there is, right? Because if you're paying significantly above where the property is assessed at, there's going to be a lot of real estate tax exposure likely in the future for you. So that's what we're trying to get here. It's not going to be pinpoint accurate unless you want further customization, but it is enough to be dangerous. So in Minnesota, the taxes would reassess in year 2. That's when you'd start to see the increase in taxes payable each year. And just to play it safe, I'm going to say that this property reassesses at 100% of the sales value. And then I'm going to type in for real estate tax increases for the reassessment years, 2%. So if the property is not reassessing, it's just going to be a 2% increase every single year. All right, so now I need to go back to our assumptions page, and you can see that I got some tax information offline. In Minnesota, taxes are paid in a year arrears. So we're in 2019 right now, but the 2019 taxes are based off of the 2018 assessment. So for the current year taxes, I need to first specify that the assessment year is 2018, the taxes payable is 2019, the assessment amount was $1,680,000. Oops, $1,680,000. The taxes payable $31,920. The tax rate will calculate it automatically. In some states, there's discounts, so they'll offer you 3% off or 4% off if you pay the taxes by a certain date instead of in increments. And then if there's a special assessment, this is the cell you would enter that in. So the following year taxes will enter automatically. If you know next year's assessment, you can enter that here. So for example, in Minnesota, we already know what the 2019 assessments will be, and that's going to determine what the 2000 taxes payable are. If you didn't know, you can just leave it blank. And same with taxes payable. If they're proposed, you're more than welcome to put that in here, or you can just leave it blank, and the model will make an assumption for you depending on the tax rate that's being calculated this year. So we know what the assessment is, $1.75 million. We still don't really know what the consequences are going to be of this 100% reassessment 2 years after sale, because we haven't entered in a price yet. So once we enter in the price we're going to pay for this, then this table will be a lot more valuable. So that's the next step. So this is the final tab where you have any inputs you need to enter. The first thing is the price. So we'll say the broker's pricing guidance was $2.5 million. All right. And then primary financing. Remember we typed in the financing assumptions on the summary tab. And in this deal, we didn't have a secondary financing option. So we're just going to say yes for primary financing. We're going to leave secondary financing as no. And then we're going to put in some working capital. This is 24 units. We're going to implement a RUBS program, do some light cosmetic stuff to hopefully get that 5% increase in years 1 and 2, like we had inputted on the financials tab. So I'm going to say $2,000 per unit or 48 grand. And that will just be spent year 1. So you can see that populated right here. So now that we have everything input, let's kind of work our way backwards. So now the real estate tax table is updated. You can see because the assessment increases 4.17% in 2019, that's what the taxes will increase by as well. There's going to be a big jump, right? Because it's only assessed at 1.75. If we paid 2.5 million, that's going to create quite a bit of tax liability. You can see that it's 42.86%, and then assessment growth after that will just be 2%, which is what we stipulated up here. The tax rate is just going to be steady, hold steady at 1.9%, which is current year payable divided by the assessment amount. These cells are brown, so you can overwrite this if you really wanted to underwrite conservatively, like maybe you increase 1.9 by 5 basis points a year. Discounts and special assessments tie to these cells. But if you did want to put in a custom discount each year, or you thought the special assessment would be done after 3 years, this is where you can make those adjustments. You're more than welcome to override formulas if necessary. So then we get back to our financials. Now that we have real estate tax entered, you can see it's $32,250 in year one, and that's going to take a pretty significant jump as the property reassessment is factored into the taxes payable number. So if we keep moving backwards and go back to the summary tab, now what's interesting is I have this pricing. So it summarizes $2.5 million. That would translate to $104,167 per unit, or $139, call it, per square foot. So here you can adjust your hold period, and you can see how it affects the IRR and the equity multiple. So the longer you hold it, the higher the equity multiple will be. We also have some cap rates. Astute investors will always look at this tax adjusted cap rate. Remember, real estate taxes are going to jump like 42% once the reassessment happens. So, on T3, T12 numbers, paying $2.5 million as a 5.3 cap, which may seem reasonable in your market. But remember, we need to add in a lot of expenses that the current ownership group was not accounting for. And then there's going to be that massive real estate tax liability that when you factor that in, the NOI will decrease significantly, and it's truly a 4.66 cap tax adjusted. So, for example, here in Minneapolis, that seems insane maybe for a Class C value add product, but oftentimes the cap rate dips into the fours because of this tax liability, and just because some of the upside that these investment groups will see. So let's go back to the valuation tab and just scroll over and summarize some of these metrics here. So it summarizes the price above, the per unit, the per square foot, and then it has all these cap rates. And I use some conditional formatting so you can see with the T12 and the T3, T12, you can see how much the real estate taxes will adjust that cap rate, and it turns into that dark red. Just so you're aware that if you're buying a deal significantly above the assessed value, there's some risk there. It's going to summarize the capital assumption. It's going to summarize some of these closing costs, these escrow. And closing cost needs to be a currency. Yeah, 45,000 looks better. And then our cap rate assumption, remember, it's 5.5% with 1% increments each year. If we scroll down in the model, you can see where that's happening. So we're jumping up by 10 basis points each year. That's affecting the residual value. So for example, the residual value in year 5 is taking the NOI year 6, dividing it by the 6% residual cap. And then we determined all of our closing costs, which is this brokerage commission and other closing costs, which is this negative 109,000 would be the 4% times the residual value. And then our loan is being tracked as well. And that loan pay down will determine the proceeds at sale. So then we get into some of the other metrics. We have an all-cash IRR, a leverage IRR, and an equity multiple. The all-cash IRR is an IRR that ignores the debt. It would be your returns if you just wrote a check for this deal, straight cash, no financing. And I always like to include all-cash metrics because it will help you distinguish if you're getting a nice boost from your debt. Hey, debt can be risky. Leverage can be great, but it can also sink the ship. So make sure that you're always comparing your leverage returns to how it would look without any debt. So once you get down to the cash on cash returns, again, I do the same thing. I compare it to an all cash return, meaning there's no debt. If you just pay 100% in cash, you can see early on in the deal in years 2, 3, and 4, the cash on cash return early in the deal, which is factoring in the leverage, it's actually less than your all cash. So these first few years, the debt's actually not accretive. Most deals that brokers are selling these days, at least in my market, this is pretty much commonplace for the first 3 years, 4 years or so until the ownership group can grow revenues enough where the debt actually becomes accretive. But it would be a little worrisome, if you're taking out this debt and you hit a snag and you're not able to grow to rents as much as you projected. So for this deal, I would 2.5, I would maybe see what the returns would look like at 2.25 million. So decrease the price by 250 grand. Now the cap rates seem a lot more reasonable, even tax adjusted, it's like mid 5s, which feels a lot better. The The levered IRR, which is a metric I like, is boosted a little bit. Year 7, it's in the mid-teens, which feels a lot better. The equity multiple is getting close to 2.5 on the project. And the cash-on-cash returns are larger than the all-cash returns every year. So that would mean that this deal is producing enough cash flow in its current state at the price point where the leverage is accretive. You have powerful leverage here that's going to help boost the returns of the deal. So I would get a feel from the broker if 2.5 is really real, or maybe just put in an offer where you're comfortable. The key is to know what you want going in, whether it's an IRR or a cash-on-cash return that would satisfy your goals or your investors' goals, and not budge from that. If the market wants to pay more, leave that to the market to do so. I should point out the final tab. There's no inputs here. It's just the debt stuff. So if you're just looking, you type in all your debt information on the summary tab. This is just where the cash flows are being summarized. So if you're wondering how the debt is flowing into the pro forma, you can click that little X on top and it will show you what the debt cash flows are, what the principal interest payments are, and what the loan payoff would be in each year. If you're assuming the loan, this is the table you'd be paying attention to. But we're doing free and clear, so this is specifically what is flowing into the model for the current deal. So just to wrap up this valuation page, it's pretty powerful stuff. You can see whether you're holding the deal for 2 years or 7 years or 10 years, you can see what the corresponding IRRs and equity multiples would be and what those cash-on-cash returns would be over the hold. You can also go to the front of the model and you can just play with different hold periods if you just want it summarized really fast without having to go back to that page. Type in 4 here, you can see the IRR changing. And then the cap rates. The cap rates are you can choose 3 of the 6 that are listed here. Just whatever your preferences are, you can choose those to be displayed on the summary page, and it's just going to give you a quick feel for the property, and you're not going to have to be bouncing back and forth between the sheets as much. So that really wraps up the tutorial of this financial model. Again, I think once you get used to it, it should take you about 20 to 25 minutes to model a property. There are some shortcomings here. If you're doing a true value add deal where there's upside if you're renovating the units, I do have paid models that break down the unit mix by the original and the renovated units, and you can come up with rental premiums specific to each floor plan. You can make capital assumptions for each unit type and floor plan. And the model does a really good job at just breaking down that renovation rent growth and the capital spent per year and your return on cost. And it's even more powerful because it allows you to alter the timing of your renovation plan, whether it takes 2 years, 3 years, 4 years, or how many months the units will sit vacant when you're aggressively renovating them. There's no partnership returns in this model. I have other paid products that it would flow into partnerships, and you can experiment with different structures, whether it's an IR waterfall or pari passu, or you just want to do a 80-20 split with your equity investors, whatever the case might be, or a preferred return even, and then a split after that. I have all that in different models. And then the other thing is just major capital expenditures. So whether you're renovating units or there's a significant amount of deferred capital, most people syndicating equity will raise that on the front end. This model is limited because any capital items it's subtracted from the cash flow. So I have other products where you're able to specify how much of the capital, whether it's renovations, deferred matrix, you would raise from investors. And then obviously that's going to have a significant impact on returns, whether it's IRR or cash on cash, because the basis will be higher going into the investment if you're raising it on the front end. And then just stress tests. This model, you're more than welcome to plug and play with the different assumptions. But I always say a more powerful model, it's going to utilize the data. And it's going to utilize the data you've inputted, and it'll have tables that flawlessly stress the model. So you're aware of the best and worst case scenarios without having to alter assumptions 100 times and try different rents and different growth strategies and different financing. And so some of my other paid products have built-in stress capabilities if that would be something interested you. But hey, this is my free model. It truly is meant to be just if you're initially vetting a deal, get a quick back of the napkin, understand what's going on, and know if you want to pursue it further. And I hope it serves that purpose. I hope it's clean. I hope it's easy to use. And if you have any questions, comment below. If you're watching this on YouTube, send me an email direct. And I'm always going to be improving these things and fixing bugs and just making it tailoring it to you guys and what you're looking for. So thanks for checking out the video today. I hope you enjoyed it, and please come download it and let me know what your thoughts are. Thank you.